Hong Kong's external environment looks fragile, and in Hong Kong itself, there are calls for changes in Hong Kong's economic model so as to suit the rising inspiration of the public. I am going to speak to Professor Francis Lloyd, Head of Economics Department of the University of Science and Technology, who is also a distinguished analyst of Hong Kong economy. Francis, welcome to our video. Heading into next year, 2013, the global economy seems to be gloomy. How strong is Hong Kong's economic fundamental? What are your views on the economic outlook of next year?
Hong Kong is a very outward-oriented economy, and because the economy in the world has not fully recovered, so in that regard, Hong Kong's economic well-being will surely be affected somewhat and will be continued to be affected. But I think that the US economy will have a better chance to recover sooner. I'm more pessimistic about Europe. In that regard, I think that Hong Kong's economy next year will still be fine. However, I don't think that the Hong Kong economy will be doing extremely well, just like the very old days when we had, say, 6 or 7% growth rate per year. The exports and imports in China may still slow down somewhat. That may not hurt China itself too much because what matters to China is the trade surplus. The trade surplus is going up. However, the total volume of the trade may suffer some setback, and that will concern Hong Kong.
Inflow of money, people, and goods from the Chinese mainland have been very important for Hong Kong in the past 10 years. Now, the Chinese economy is going to slow down in the coming years. What do you think in the future that the slowdown in Chinese economy's impact on Hong Kong's different sector for, say, retail, finance, and property?
First of all, I'm a bit more optimistic about the China economy. Certainly, this year, China's economy has slowed down somewhat. I'm anticipating that for the whole year, the growth rate could be like 7.8% or so. Next year, it could move up a bit. But in the long run, even in the longer one, I believe that China's economy will remain a very important engine of growth for the global economy as well. Because of that, we may expect more consumption coming from China to Hong Kong, more demand for consumption, and capital may still come to Hong Kong. Hong Kong may serve all kinds of purposes for China's businessmen and also consumers, tourists, and so on. Because of that, there's a good chance that capital will continue to come to Hong Kong. Well, this is good and bad. Good in the sense that Hong Kong's exported sector in terms of services especially, and sometimes in terms of the consumption goods, may still be doing relatively well. The negative part is that when capital continues to come to Hong Kong, much of the capital may be earmarked or targeted at buying properties or stocks. I don't think that usually the investors from China that's concerned about buying consumer products. Well, that means I'm on the optimistic side of the stock market, but the Hong Kong government has already come up with different measures to curb the inflow of capital for the sake of buying properties in Hong Kong. Also, the inflow of capital could cause the consumer price index to go up somewhat. However, there could be different ways for the Hong Kong Monetary Authority to reduce the impact. So what they do is that when money comes in, then they will buy the money and then send the money out again. So the actual increase in the money supply in Hong Kong may not really be that big. So there will be inflation, but I don't think that the inflation rate will be very high.
As you mentioned, that apart from the inflow of money or capital from the Chinese mainland, that the increase in international liquidity caused by central banks pumping money into their major economies also really creating the pressure on asset price escalation and inflation in Hong Kong. People are talking about any measures Hong Kong can take to mitigate the asset bubble, and also is a repackaging of the exchange rate an alternative?
When international capital comes to Hong Kong, they are mostly interested in buying some kind of more liquid type of assets like stock shares. I don't think that they are directly interested in buying properties in Hong Kong. Well, China's investors will be more interested in buying properties, but not these American or European investors. So with a QE3 still there, and with the addition of $40 billion adding to the monetary base every month, some money will surely come to Hong Kong. But do we need to change the monetary system to cope with that? Well, yes and no. Right now, Hong Kong has already got some methods to deal with this international inflow of capital. Well, the monetary base in Hong Kong has gone up quite a bit. Now we are talking about something close to 150 billion Hong Kong dollars. So that is actually one of the ways to deal with the inflow of capital. But the more important step is for the monetary authority to use its exchange fund bills and notes to absorb the currency. But once after they've got the foreign capital, they use the money to buy American bonds once again. But coming to the question of whether Hong Kong has to reconsider changing the peg, I don't think that there is right now any plan in doing so. I do not believe that the currency board system in Hong Kong is something that will last until eternity. It is a human-created institution, so it will change. But there are some conditions that will be needed before it can change. In the future, perhaps it will be pegged to a basket of currency or just the RMB. Even if it is pegged to a basket of currency, the RMB will be a very important component there. Well, 52.4% of Hong Kong's total exports goes to China now. So before the RMB can become internationally convertible currency, I don't think that the HKMA has a very strong incentive to really go through a drastic change in the system.